A few months ago, a friend of mine called up. He was excited about a stock and he wanted to share his so-called discovery. The stock, Aster DM Healthcare, had a PE of 134 times until June 2024. But then, the PE suddenly dropped to just 3 times. My friend felt the stock was quite a bargain at those levels. Well, when I checked the company's numbers, I found out that its profit had jumped to over 5,100 crore in the first quarter of FY25 from just 20 crore in quarter 1 FY24. Now, due to this massive profit jump, the company's PE had fallen to just around 3. But when I dug deeper, I found that the source of this profit was not core business performance, but an exceptional gain. The company had sold off its Gulf business. Now, when I told my friend about this, he was disappointed, as his bargain stock wasn't such a great idea after all. But he also thanked me for letting him know the accurate picture. Now, this is one of the many ways the PE ratio can fool investors. Fortunately, it's a rather simple one to spot. Some of other ways in which PE ratio can deceive investors are rather subtle. But what are the other ways? And more importantly, what should you do in those cases? Well, that's the topic of today's video. Hello and welcome to ET Money's YouTube channel. In this video, we will talk about 5 prominent ways in which PE ratio can fool you and what you can do about it. We will also take a look at a number of alternative valuation metrics that you can use to compensate for the shortcomings of the PE ratio. Now, if you're an active stock investor, this video will be immensely beneficial to you. So do watch it fully. Even fund investors will find this video useful as it can help them analyze their funds better. Now, this video belongs to our playlist on investing lessons. If you would like to watch more such videos, you can explore it. The link is in the description. So let's hit the ground running. The PE ratio is derived by dividing the stock price by the earnings per share or EPS. In essence, it means how much you are paying for 1 rupee of a company's earnings. So by extension, the lower the PE, the cheaper the stock. However, this is a rather simplistic conclusion. As we saw at the beginning through Aster DM's example, a low PE ratio doesn't automatically mean a cheap stock. Now, the PE ratio can become optically low due to a temporary high profit figure. This could result from an exceptional gain or even an operating income of temporary nature. Aster DM is the example how an exceptional gain can artificially deflate the PE ratio. Let's see how a temporary jump in the operating income can deflate the PE ratio. Consider HEG and Graphite India, 2 manufacturers of graphite electrodes used in steelmaking. Now, between 2017 and 2019, there was an acute shortage of graphite electrodes. This was driven by pollution-led capacity cuts by China, which is the largest producer of graphite electrodes. Now, due to this, HEG and Graphite India witnessed a massive temporary demand, which boosted their operating profits in FY18 and FY19. Now, these high profits pulled the P's of the 2 companies down. As of March 2019, both the companies traded at a PE of just under 3 times. However, as this temporary phase ended, the profits of 2 companies normalized. So this example suggests that if a PE of a company dramatically collapses, you shouldn't take that as a bargain. Rather, dig deeper to find out the reason for the fall. Now, the PEs of cyclical and commodity stocks also tend to show steep fluctuations depending upon which phase the company's earnings in. For instance, consider the PE and net profits of Tata Steel, a cyclical company. As the company's profits have fluctuated, so has its PE ratio. At the end of FY22, the company's PE stood at just 4 times as the profit stood at a massive 42,000 crore. But at the end of FY25, the PE was much higher at 56 times amid subdued profits. And that's why the PE is often a wrong measure to judge the valuations of cyclical or commodity stocks. So, in place of PE, one should take a look at either the price to sales or price to book ratios. Now, as their name suggests, these ratios are obtained by dividing the stock price by sales per share and book value per share respectively. Now, both sales and the book value are much steadier than earnings and hence can be a better gauge to judge valuations in case of cyclical or commodity stocks. So, if we analyze Tata Steel's valuations in terms of the price to sales or price to book ratios as of March 2022, the stock was clearly at a premium. Now, another reason for a lower PE is poor business outlook. The market tends to award a low PE multiple to a stock whose prospects aren't sound. So a low PE can actually be an indicator of business problems or low business or industry growth rather than inexpensive valuations. For instance, utility stocks Paper stocks and textile stocks tend to be available at lower valuations due to the low industry growth rates. Lately, the P multiples of IT index have compressed amid a subdued outlook for the sector. Overall, when you encounter a low PE stock, don't automatically consider it to be a bargain. Rather, dig deeper to find out why it's at a low PE. Now, more often than not, there would be a solid reason for it. And this brings us to the next case of PE. But before that, something useful. You can now get cash to enjoy your present while staying invested for your future with loans against mutual funds on the ET Money app. The interest rate is just 10.75% per annum and there are no fixed EMIs. Pay interest monthly and repay the principal amount whenever it is convenient for you. Plus, there is no need for a CIBIL score. So go ahead, check your eligible limit on the ET Money app. But wait, there is more. If you set up your loan account by July 31st, any outstanding balance for the next 3 months will be charged a special rate of 9.99%. So go, do it now. Many investors tend to frown at the high PE and filter out a high PE stock at the outset. That is often a mistake. Now, just like there are reasons for the stocks to be at low PEs, there are also reasons for them to be at high PEs. Like one-off gains, one-off expenses can result in high PEs. If a company is in a capital-intensive business and needs to incur high capital expenditure or capex, and for that, it needs to take on debt, the resulting interest costs and depreciation can add to the expenses and inflate the PE ratio. Now, two such industries are hotels and hospitals. The companies in these industries tend to have high interest costs and depreciation outgo, as depicted by their significant interest to sales and depreciation to sales ratios. For such industries, enterprise value to EBITDA is a sensible alternative. The EV to EBITDA ratio helps evaluate companies regardless of their capital structure and non-cash expenses. Enterprise value or EV is the total cost of acquiring a company. It is calculated by adding the market cap and debt and removing the cash on the balance sheet. Now, EBITDA is earnings before interest, taxes and depreciation. It's also called operating profit. Naturally, the lower the number, the better, but you can use it to compare companies within the same industry. Now, you can also use a company's historical values of EV to EBITDA to make sense of its current valuations. Take a look at the current EV to EBITDA values of the hospitals and the hotels that we just saw. And if we compare Indian Hotels' current EV to EBITDA to its historical median, the stock is at a slight discount. Now, apart from hospitals and hotels, the EV to EBITDA ratio is also useful for sectors like cement, airlines, metals and mining, telecom, etc. The next case when a company can have a high PE ratio is when it has robust growth prospects. In other words, if the market is bullish about the industry or a business, it tends to award a high PE multiple. Now, to make sense of the valuation of such companies, a better metric is PE to earnings growth ratio or the PEG ratio. Popularized by the legendary investor Peter Lynch, the PEG ratio is derived by dividing a stock's PE ratio by its earning growth rate. A PEG of less than 1 is a bargain and a PEG of 2 or more indicates an overvalued stock. So on your screen are 10 companies by their market caps which have a 5-year sales and EPS growth of at least 20% per annum, whose PE is over 40 and whose PEG is less than 1. The high PEs of these companies are balanced by their high growth rates. A similar case is when a company has a large order book that provides solid revenue visibility for years to come. This aspect is especially useful for manufacturing companies, and a related metric to use for such companies is the market cap to order book ratio. The lower this number, the better. But you can also compare companies within the same industry to assess their relative valuations. A prominent example of an industry where the market cap to order book ratio matters is the defense industry. Here are some prominent defense stocks along with their market cap to order book and PE ratios. Consider, for example, Garden Reach Shipbuilders here. While the stock has a high PE of 58 times, it's available at a market cap to order book of just 1.28. Of course, orders aren't revenue and not all orders convert into revenues. Yet the market cap to order book conveys something important when seen vis-a-vis the PE ratio. At this juncture, I must tell you that these companies or any of the companies discussed in this video are not our recommendations. The idea is to illustrate the shortcomings and alternatives of the PE ratios with examples. If you're interested in any of the stocks mentioned in this video, don't forget to do your own research. This brings us to the next way the PE ratio can prove to be deceptive. As we saw, the PE ratio is calculated by dividing the stock price by a company's earnings per share or EPS. Now the EPS is in turn derived from net profit by dividing the net profit by the total number of shares. But a company's profit figure isn't always reliable thanks to accrual accounting. Accrual accounting allows booking of profits without receiving the corresponding cash flow. And that can make the company's PE ratio deceptive too. Take a look at some companies in the BSE 500 that have posted a net profit but whose cash flows are negative. This discrepancy could very well be due to nature of business and accounting rules. Yet the deviation between the profit and CFO should not be taken lightly. And that's why it makes sense to check a company's market cap to CFO ratio in addition to the PE ratio. If a company looks cheap on PE but expensive on P to CFO, the earnings may not be very reliable. Now on your screen are some companies that illustrate this. If you'd like to learn more about cash-related analytical metrics, you can watch a related video on the topic. The link is in the description. Okay, let's move to the next aspect of the PE ratio. So banking and financial companies are usually valued using the price to book ratio and not the PE ratio. And there are good reasons for that. Banks and financial companies rely on their balance sheets to generate income. The loans that they give are their assets, the deposits and borrowings are their liabilities. Their profits originate from the spread between the interest they charge on the loans and the interest they need to pay on the deposits and borrowings. As such, their profitability is closely tied to the size and quality of their balance sheet. Moreover, their balance sheet is also marked to market, so it reflects the true picture of the business health. That's why banks and financial institutions are usually valued on the price to book ratio. On the other hand, using the PE ratio for finance companies can be problematic. That's because a finance company's earnings can be rather volatile due to business cyclicality caused by provisions, credit demand, interest rates, etc. For instance, consider the recent case of IndusInd Bank. The bank's earnings were hit hard due to the losses originating from its derivative portfolio and microfinance business. This has resulted in a sharp jump in its PE ratio. But its PB ratio is much steadier and is actually below the 3-year median of 1.75. Now, given the problems with the bank, this discount to the median reflects the pessimism the market has towards the IndusInd Bank. If we compare the IndusInd's PB with that of other banks, a similar picture emerges. Similarly, in insurance companies, the balance sheet reflects investment portfolios and liabilities, and earnings can be volatile. So, PB ratio is more useful than the PE ratio. In life insurance, a specialized valuation metric used is the price to embedded value ratio. It's a complicated metric, so we'll try to discuss it in a separate video on insurance stocks. Now, one case where the PE ratio simply fails to produce any result is when the company is loss-making. Since the PE ratio uses earnings in its denominator, a net loss makes this ratio invalid. In such cases, you can see other valuation ratios such as price to sales ratio or the price to book ratio or the price to cash flow ratio, etc. Okay, let's now move on to the final pointer, which is an interesting one. There is one subtle way in which the PE ratio can throw an inaccurate picture of the company's stock. It's when the PE ratio changes not because of the price or net profits, but due to the number of shares involved. As we saw, one of the two components of the PE ratios is EPS, which is calculated by dividing net profit by the number of shares. Let me illustrate this aspect with a hypothetical example. Suppose a company stock trades at 1000 rupees and the net profit is 500 crore and the number of shares outstanding is 10 crore. This gives the stock a PE of 20 times. Now, even if the stock price and the net profit remains unchanged, but the number of shares changes to 11 crore and say 9 crore, the PE will change to 22 and 18 respectively. This shows that while stock price and earnings are the primary determinants of the PE ratio, you should also keep a tab on the underlying share count. If the company issues fresh shares, the stock PE can go up, and if a company buys back its stock, the PE can fall. Okay, so far we have discussed quite a few issues with the PE ratio. Now, one question that arises here is if you should ditch this ratio and not use it at all. Let's answer this question in the concluding section. The PE ratio is the most popular metric to assess valuations, and that's for a good reason. Valuing a business in terms of its earning is quite a sensible approach, given that generating profits is an important goal of any business. But using the PE ratio does have some pitfalls, which we have discussed in this video. The objective of this video was not to stop you from using the PE ratio. Quite the contrary. The idea was to discuss how you can better use the PE ratio. Using other valuation multiples in conjunction with the PE ratio can help you better analyze stocks. If they are throwing conflicting signals, that's where you must dig deeper and find out why that's so. As a general rule, whether it's the PE ratio or any other valuation multiple, don't consider it to be sacrosanct. Consider it to be a means to an ultimate objective of picking good stocks. And with this, we have come to this end of this video. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.